Welcome. It's nice having you. After this massive rally that we have had in the stock market, there's a lot to consider of what's going to happen with our economy, companies, and all of the different aspects to the stock market. My name is Nathan Crampy. I'm the founder and lead wealth advisor of Lions Wealth Management. Now, the S&P 500, what I call the stock market, was up last week. A sharp bear market rally off of the March 23rd lows has now retraced basically half of the decline in just really 13 days. Now, this advance off the lows is normally considered the start of a bull market, but these are not normal times. So what I want to say is this: resist the glass half full notion that some of the bear market is over and that a return to normalcy is just around the corner. This is kind of wishful thinking a little bit, and I know we want to be positive. I know we want to say the worst is over and that we can start resuming things, especially if things start to open. But since no one really knows how long the social distancing and quarantine mandates will stay in force, and what the longer-term effects to the U.S. economy are going to be, a groundswell for early opening of the economy has helped contribute to this rally, but the Federal Reserve Board's unprecedented, decisive, kind of do whatever it takes attitude is really what's driving the bear market rally. So, social distancing and sheltering in place has resulted in an engineered shutdown of the U.S. economy. 16 million Americans, or a little over 10% of our workforce, has filed for unemployment insurance in the last 3 weeks alone. Now, many of these people are low-income wage earners who were the first to be laid off. According to the Wall Street Journal, 25% of American businesses are shut down, and with the damage initially concentrated in the restaurant, travel, tourism industries, as well as the retailing sector. That's the bad news. Now, the good news is that there's various mitigation efforts to contain the spread of COVID-19 that seems to be working. What comes next is very much up in the air, and with the Fed providing virtually unlimited liquidity for a broad range of fixed income instruments, including high yield, exchange traded funds, and municipal bonds, the pressure is off a little bit of that respect, but now it's on the Treasury to actually deliver the money to the individuals and small businesses, in addition to the large company bailouts that they're trying to provide. So my view is that this recent rally has set the stock market up for disappointment, and is yet to come on the earnings and the economic front. We have first quarter earnings that are just restarting, and these reports will not be kind of accompanied by the usual what you call guidance. Company and managers are in the dark as to the length of the mandate shutdown and the timing of reopening the U.S. economy. So the intermediate to long-term effects of the coronavirus on consumer spending and behavior patterns are a little unknown. The future of our markets and the lives now of all of us now depend on the decisive steps of Washington regarding testing, monitoring, and containing COVID-19. Once these three phases are successfully implemented, the U.S. economy will be back open for business. However, we still don't know the effects of the virus on the consumer and the corporate spending patterns. So maintaining whatever level of cash is needed is a little bit more prudent at this stage of time to help ride out this kind of bear market a little bit. So what's going to be expected here is that we have first quarter earnings reports kind of coming out, and there's really no guidance in place for this. So that's starting to be coming out not only this week, but most importantly next week is where all of this will come out. And the investment banks are expecting a 30% drop in our gross domestic product, what we call your GDP, kind of the earnings of our economy, in the second quarter because of the shutdown. Now, a recovery and its timing is up for debate. So bear market rallies typically peter out as bad news has a convenient way of resurfacing. And this rally off of the March 23rd lows has set the stock market up for disappointment. And if the hope for a return to normalcy in our daily lives in the U.S. economy is pushed out, I fully expect the markets to have at least one more down leg. So what you call the proverbial retest of the lows can still happen. It can take many forms, and we need to be watchful and wary of the kind of that happening. And the second wave also could be of a downturn and what that would look like. Now, I've talked a lot of very much in technicalities of things, but for the reason that I'm talking about all of this is I continue to be cautious as the next phase of this mitigation efforts take hold and kind of this market unfolds a little bit and the economy unfolds. So until the spread of COVID-19 virus peaks and we are closer to reopening the U.S. economy, right now it's a little more prudent to be more cautious than not. And if we're fortunate enough to see an effective treatment, there will be plenty of room to grow with the stock market and your accounts. But right now, capital preservation is more important than capital growth. So that's kind of a lot to be thinking about here. I've really kind of been a little more technical with this versus some of the others that I've been, but I wanted you to know that there's still opportunity to come, but right now we need to get through this period of time, and I do expect there's going to be some really, really bad numbers out with some of the businesses, some of the companies, and some of the economy to come. So we need to get through this period first. Now, with that, I always say take care and have a great day, and I do mean that. We're going to get through this together right now, as we are all saying out there that it's just a matter of trying to keep our distance, trying to get through the virus first, and we'll be looking to reopen as soon as we possibly can, and then make sure we're ready for the next leg up in the stock market. Take care. Enjoy the rest of the day.